All right, buckle up, because today we're diving deep into the world of electric vehicle companies.
Ooh, sounds exciting.
It is. We're going beyond those flashy headlines and digging into their financial metrics to see how these companies are really doing.
Yeah, you can't always trust the hype.
Exactly. We've got this recent report breaking down everything.
Everything.
Yeah, from profitability to growth. And I gotta say, the insights are pretty interesting.
I bet, like getting a peek behind the curtain, right?
Yeah, because anyone can talk a big game about their revolutionary tech or their grand plans.
Mm-hmm.
But the question is, can they actually translate that into cold hard cash?
That's the bottom line, isn't
That's
it?
what we're here to uncover.
Love it. Using those metrics to see if these companies are built on solid ground or if it's all just smoke and mirrors.
Okay, so let's jump right into it.
All right.
The report kicks off with profitability, and right away we see some huge swings.
Oh,
Yeah, you've got companies like Lucid and Rivian, they're drowning in losses. But then you have others like BYD and Tesla posting some seriously impressive margins.
interesting. It's like a real mixed bag out there.
It is. And you see these terms thrown around a lot: gross margin, operating margin, net profit margin.
Right, they can be confusing.
Yeah, but they each tell us something different about a company's uh, efficiency and their ability to actually make a profit.
Makes sense.
So can you kind of break those down for us? Like, how can our listener use these numbers to really understand how these companies are doing?
Okay, well, imagine for a minute you're running a lemonade stand.
Okay, I like where this is going.
Your gross profit margin is essentially the money you make from each cup.
After you've paid for the lemons and the sugar and all that.
Exactly. It's how efficiently you're making that lemonade.
Got it. So the higher that gross margin, the more money you're making on each cup.
Right, which means you can reinvest that money back into your business.
Buy more lemons, expand your lemonade empire.
Exactly. Now, let's step it up to the operating margin. This takes into account all those other costs of running your lemonade stand, things like rent for your spot, any advertising you're doing.
Maybe even paying a friend to help you out.
Precisely. So it gives you a more complete picture of your profitability. Are you truly making money after all the costs are factored in?
Gotcha. So it's more holistic than just the gross margin.
Exactly. And then we get to the bottom line, the net profit margin.
The big one.
This is what you have left after absolutely everything is paid.
Including those lovely taxes.
Yeah, all those pesky expenses. It's the
Yeah.
purest measure of your profit.
Makes sense. So let's take a look at our report.
All right?
Tesla's boasting a net profit margin of 13.07%.
Not bad.
Seems pretty healthy, right? Especially considering all the investments they're making in new factories and technology.
It's definitely impressive.
It shows they're not just selling a lot of cars, but they're doing it in a way that generates real profit.
Yeah, their economies of scale seem to be working.
Right. Their costs are down and they're outpacing the competition. Now, flip side of that coin,
Oh.
we have Rivian with a net profit margin of, get this, negative 115.5%.
Oof, that's a lot of red ink.
Yeah, that's a lot of money going out the door.
It is. What does that tell us about their approach?
Well, it seems like they're spending a ton to ramp up production.
Grabbing that market share.
Yeah, even if it means operating at a loss for now.
So it's like a big bet on the future
Exactly, hoping that eventually they'll get big enough.
and bring those costs down.
Right, and finally push them into the black.
A classic spend money to make money strategy.
But the big question is, how long can they keep this up?
Right. At what point does that spending become unsustainable?
Investors are definitely going to be watching that closely.
For sure.
And speaking of efficiency, let's move on to the next set of metrics.
Okay.
It's not just about making a profit, right? It's about how well a company uses its resources to get there.
You gotta be smart about it.
Are we talking about how quickly they can get those EVs off the production line and into the hands of customers?
You're on the right track. We're talking about asset turnover and inventory turnover.
Okay, those sound important.
They are. These ratios give us a peek into how efficiently companies like Tesla and Rivian are converting their assets into actual revenue.
So their factories, equipment, even the cars sitting in their lots.
Exactly. Every piece of the puzzle.
Okay, so help our listener out here.
Sure.
What can they learn from these ratios about a company's operations? Especially in this fast-moving EV world.
Well, let's go back to that lemonade stand for a second.
Okay, I'm picturing it.
Asset turnover is like seeing how many glasses you can sell each day using that one pitcher you have.
Right, so the more lemonade you sell with that one pitcher, the better.
Exactly. A higher ratio means you're squeezing every bit of value out of your equipment.
Which is a sign of a good business.
Precisely. Now, inventory turnover, that's even more specific to our EV companies
Okay.
is how quickly they can sell those brand new EVs they have.
So a high turnover means they're not just building cars, they're getting them out there quickly.
Yes. And that's crucial in this market because technology changes so fast.
New models all the time. You don't want a warehouse full of outdated EVs.
Nope. A high inventory turnover shows strong demand, good production, and a smooth supply chain.
All key ingredients for success.
Absolutely.
All right, numbers time.
Get me.
Tesla's in the lead, as usual, with an inventory turnover of 5.62.
Wow.
That's almost 6 times a year they're selling and replacing their entire inventory.
Talk about a well-oiled machine.
They're not just building cars, they're building anticipation.
Yeah, very clever.
Now, Rivian, they're at 2.98.
Still decent?
Not bad, but it does make you wonder, are they having some production hiccups?
Or maybe they're being cautious, not wanting to overproduce.
Good point.
It's something to keep an eye on.
And speaking of keeping an eye on things,
Jogat.
there's this other metric here, daily sales outstanding.
DSO.
That's a new one for me.
This dives into how well these companies manage their cash flow.
Okay, tell me more.
It measures how long it takes them to get paid after a sale.
So shorter is better, right?
Generally, yeah. They get their cash quicker, can reinvest it.
Keep that money flowing.
Especially important for those companies burning through cash fast.
Like Rivian.
Exactly.
Well, look at this. Lei Auto has a DSO of just 0.33 days.
Wow, that's
They're
amazing.
practically getting paid before the car leaves the lot.
Talk about efficiency. That's a real advantage.
Big time. Now, compare that to Geely.
Okay.
Almost 57 days.
Whoa, that's a long wait.
Makes you wonder what's going on there, right?
Definitely raises some questions.
It seems like these metrics are like pieces of a puzzle.
I like that analogy.
When you put them all together, you get a much clearer picture of how a company's actually performing.
Absolutely. And speaking of uncovering the truth,
Ooh, sounds intriguing.
let's move on to liquidity and leverage.
Okay, because that's where we see how these companies are managing their risk.
Right. Are they financially sound or are they playing with fire?
I'm ready to dive in.
Let's go. So when we talk about liquidity, we're basically asking, do these companies have enough cash on hand to cover their immediate expenses?
Like, to keep the lights on and pay the bills.
Exactly. It's all about whether they can meet those short-term obligations without having to scramble, like selling off assets or taking on more debt.
So it's like having enough money in your checking account to cover those unexpected expenses that always seem to pop up.
Exactly. And to assess that, we look at a few key ratios: the current ratio, the quick ratio, and the cash ratio.
Okay, those sound kind of technical. Break those down for our listeners. What are we looking for in these ratios? How can they use them to understand a company's financial health?
Well, let's start with the current ratio.
Right.
It compares a company's current assets, things like cash, money they're owed, and inventory, to their current liabilities.
Which are basically debts that need to be paid within the next year.
Right. So a higher current ratio generally means they have more assets to cover those short-term debts, which is a good sign.
So like a ratio of 2 or higher is generally considered healthy.
Often, yes, but it can depend a bit on the industry.
Ah, right. Context is key.
Exactly. Now, the quick ratio is very similar, but it excludes inventory.
Why is that?
Well, inventory can be slow to sell, especially in a market like we've seen recently with all the volatility.
So it's a more conservative measure, looking at assets that can be quickly turned into cash.
You got it. And then we have the most strict measure, the cash ratio. This one only considers the company's most liquid assets, basically cash and things that can be immediately converted to cash compared to those current liabilities. It's like asking, if things went south tomorrow, could you cover your immediate bills?
It's a real stress test. So let's see how some of these EV companies measure up. Rivian, for instance, has a current ratio of 5.25. That seems like they're in a pretty good spot.
It might seem that way on the surface, but remember, we need to consider this in light of their profitability or lack thereof.
Right, they're burning through cash pretty quickly.
Exactly. So that seemingly comfy cushion could disappear fast.
So it's like having a full gas tank but a leaky fuel line. You might have plenty to start, but you'll be in trouble soon if you don't fix that leak.
That's a great analogy. It highlights how important it is to look at all these metrics together in context. A high current ratio doesn't necessarily mean a company's in the clear if they're bleeding cash due to inefficient operations.
It's a reminder that numbers can be deceiving if you don't understand the full story. All right, let's switch gears a bit and talk about leverage. I know this is a big one for investors because debt can be a powerful tool for growth, but it can also be risky if things take a turn for the worse.
Absolutely. Leverage is all about how much a company uses debt to finance its operations. It's like a double-edged sword.
Right. Used strategically, it can fuel expansion and boost growth. But if a company gets in over its head, that debt can become a real burden, especially if interest rates go up or the economy weakens.
Exactly. So it's a delicate balance, and we use a couple of key ratios to assess that risk, the debt-to-equity ratio and the EBIT to interest expense ratio.
Okay, let's break those down, starting with debt to equity.
All right. This ratio tells us how much of the company's financing is coming from debt compared to investments from shareholders.
So a higher debt to equity ratio means they're relying more on borrowed money, which could make them more vulnerable to economic shocks.
You got it. It's essentially a measure of their financial risk. Now, the EBIT to interest expense ratio tells us how comfortably a company can cover its interest payments on that debt with its earnings. EBIT stands for earnings before interest and taxes, so it's a measure of their core profitability from operations.
Okay, so a higher EBIT to interest expense ratio means they're making enough profit to comfortably handle their debt obligations, right? That's a good sign.
Exactly. It indicates that their debt load is manageable and they're not being squeezed by those interest payments. Let's look at Tesla, for example. They're known for their innovative financing and strong cash flow, and their debt-to-equity ratio is just 0.11.
Wow, that's incredibly low. It really shows they're not relying heavily on debt to fuel their growth.
Right. They've been able to finance their expansion through equity, and that strong operational cash flow we talked about earlier, it's a sign of a healthy business model and their ability to attract investors.
Now let's contrast that with General Motors, which has a debt to equity ratio of 1.75. That's quite a bit higher. Does that raise any red flags?
It's something to look into for sure. A higher debt-to-equity ratio isn't inherently a bad thing. It could be a strategic decision. However, it does mean they're using more leverage, and that increases their sensitivity to things like economic downturns or changes in interest rates.
It's a reminder that each company has a unique risk profile, and investors need to be aware of those differences. Speaking of making informed decisions, let's move on to valuation. This is where we get to the heart of whether a company's stock price is justified or if it's being driven by hype.
Valuation. The million-dollar question. Is the market getting it right, or are there hidden gems and overinflated bubbles waiting to be discovered?
It's like trying to crack a code, figuring out if a company is worth its weight in lithium or if it's all just smoke and mirrors.
Exactly. And to help us decode, we have a bunch of valuation ratios at our disposal. You've probably heard of some of these: price to earnings, price to book, price to sales, EV to EBITDA. Each one gives us a slightly different angle on whether a company's stock price is actually reflecting its performance or if it's being swayed by market sentiment or speculation.
Okay, so it's like having different tools in our toolbox, each designed to assess a different aspect of a company's value.
Precisely. Take the price to earnings ratio, or PE ratio, for example. This was pretty common. It compares a company's stock price to its earnings per share. It basically tells us how much investors are willing to shell out for every dollar of profit the company generates.
So a higher PE ratio might mean investors are really optimistic about the company's future growth, and they're willing to pay a premium for the stock.
That's often the case, yeah. A high PE ratio can reflect strong confidence in a company's ability to innovate, expand, and deliver those big earnings down the line.
But it could also be a sign that the stock is overvalued, especially if the company's earnings aren't living up to expectations or if there are doubts about whether they can keep up that growth.
You're absolutely right. We have to remember that valuation is subjective, it's based on expectations, and it's always looking ahead. It's influenced by a whole bunch of factors: market trends, how the industry is doing, even the management team, and their ability to execute their plans.
It's like trying to predict the future. We're using these metrics to make educated guesses about a company's potential, but there are always unknowns that can shake things up.
That's what makes investing so interesting, right? It's not a perfect science. There's always risk and uncertainty, which is why it's so crucial to do your research and understand what these valuation metrics can and can't tell us.
All right, let's look at some of the companies from our report. Tesla, with its sky-high PE ratio of 58.57, is obviously being valued at a premium. What's driving that investor excitement?
Well, Tesla's in a league of their own in many ways. They've really captured the market's imagination with their tech, their ambitious goals, and their CEO. Investors are betting on them to not just lead the EV market, but to disrupt other industries too. Think energy storage, autonomous driving.
So it's a mix of what they've achieved already and that vision of what they could become that's fueling their valuation. They've got the track record, but investors are also buying into the potential.
Exactly. It's a blend of what's real and what's aspirational. And you see that reflected in the stock price. Now, compare that to Volkswagen with a PE ratio of just 3.08. Why such a big difference?
Well, Volkswagen is a more traditional car maker, and they're trying to catch up in the EV game. They have a long history and massive manufacturing capabilities, but they're facing hurdles in transitioning to focus on electric vehicles and going head-to-head with those nimble startups like Tesla.
That's a key point. Investors might be uncertain about whether they can adapt quickly enough to grab a big chunk of this evolving market. That lower PC ratio might reflect a more cautious outlook on their EV growth potential.
It just goes to show that perception is everything when it comes to valuation, even for established giants. Speaking of adapting, let's move on to our final category.
Growth.
Growth, the engine that drives ambitious companies. This is where we see who's firing on all cylinders and who's struggling to keep pace.
So we're talking about revenue growth, dividend growth, any metric that shows us if a company is expanding its reach and its earning power.
You got it. We're looking for signs of vitality, momentum, the ability to scale up and meet that exploding demand for electric vehicles. This is where we see who the real contenders are.
All right, let's jump into some examples. Like Auto is posting an incredible 79.66% revenue growth. That's a phenomenal surge. What's behind that meteoric rise?
It really is, isn't it? Like, who's going to come out on top in this EV race? It's so hard to say because things are changing so fast. Yeah, it feels like the rules of the game are constantly evolving.
Right. And with so many new players jumping in, it's tough to predict who will be the ultimate winners.
But that's what makes it so exciting to follow.
Totally agree. We're not just looking at these dry financial figures.
It's bigger than that.
We're trying to understand those underlying currents.
The current.
The big trends, the strategies, the competitive forces that are shaping how we'll all be getting around in the future.
The future of transportation, baby.
Exactly. And that's where these metrics we've been talking about come in handy.
There are guideposts, right?
Yeah, they give us that structure, that framework for analyzing what these companies are good at, where their weaknesses are,
Seeing if they're financially healthy.
and whether they have the potential to really grow and make money.
So it's not just about finding the company with the highest revenue growth or the lowest debt, right?
Nope. It's about seeing the big picture, how all these different pieces fit together.
Like a puzzle.
Yeah, each metric is a clue that helps us tell the story of that company.
We have to read between the lines.
Exactly. Ask those key questions. What makes them stand out? What's fueling their growth? Are they managing their risks well?
We got to be like financial detectives.
I like that. Searching for those subtle hints that reveal a company's true potential.
Sometimes those hints are hiding in plain sight.
You never know. It might not be the most obvious metrics that give you the answer. Sometimes you have to dig deeper, look for those subtle signs that tell you a company can adapt, innovate, make things happen.
Like Rivian, for example.
Oh, right. They're spending a lot of cash to gain market share.
It's a risky move for sure.
Yeah, high risk, high reward.
But it could pay off big time if they can get big enough and run things efficiently.
That's the gamble.
It reminds us that investing isn't one size fits all.
Not at all. Some people love those risky high growth companies, the disruptors.
Others might feel safer with more established companies, those with a long history of making profits.
It all comes down to your personal style, how much risk you're comfortable with.
And, of course, whether you believe in the company's vision for the future.
That's so important. It's not just about numbers on a balance sheet. You got to connect with the companies you're investing in.
I'm curious, if you were building an EV investment portfolio right now.
Ooh, fun question. It's tough to choose just a few.
Yeah, so many options.
There are. But I think I'd look for a mix, a diverse group of companies that represent the whole EV ecosystem.
Spread the risk, cover all your bases.
Exactly. Got to diversify. So I might include those big players like Tesla and Volkswagen. They have the resources to compete globally.
Yeah, they're the heavy hitters.
Right. But I'd also want some of those up-and-coming companies in there like Li Auto or Lucid Motors.
So you're bringing something new to the table, right?
Fresh ideas, innovative tech, that's important too. And we can't forget the companies that are building the infrastructure for this whole EV revolution.
Oh, yeah, those are crucial. The battery makers, the charging station companies, the software developers, all those behind-the-scenes players.
They're all part of this big interconnected system.
Understanding those connections can lead to some smart investments, I bet.
For sure.
So, as we wrap up our deep dive into these EV company metrics,
Time to put on our investor hats.
I want to leave our listeners with one last thought. Don't be afraid to really dive in, get those hands dirty, look closely at the numbers.
Yes. Ask those tough questions. Challenge your assumptions.
At least skeptical.
Embrace the fact that it's complex, it's unpredictable.
But also embrace the opportunity. This is an exciting industry to be a part of.
Couldn't agree more. The future of transportation is electric, and it's happening right now.
We've covered a lot of ground today, from profitability to growth.
A whirlwind tour of EV finances.
But the real journey starts now as you, our listener, take what you've learned and apply it to your own investment choices.
Remember, there's no secret formula, no way to guarantee what the future holds. But if you understand these metrics, stay informed, and are willing to keep learning,
You can navigate this EV market and come out ahead.
that's the goal.
Thanks for joining us on this electrifying deep dive. We'll see you next time.